My friends, I want you to stop whatever you're doing right now and listen closely, because what I'm about to share with you could literally save you thousands of dollars. Thousands. And I'm not saying that to scare you or to get your attention for nothing. I'm saying it because I've heard from hundreds of seniors, good, hard-working people just like you, who made one simple mistake in their very first year of retirement, and they're still paying for it today. Some of them lost money they can never get back. Some of them owe the government more than they ever expected. And the heartbreaking part? Not a single one of them knew they were making a mistake while they were making it. You spent decades paying into Social Security. You worked those long shifts, raised your family, paid your taxes, and you did everything right. You earned this money, and the last thing in the world you deserve is to lose a chunk of it because nobody sat down and explained how this system actually works once you retire. So that's exactly what we're going to do today. Right here, just you and me. Let's get into it. The number one money mistake that retirees make in their very first year, and I see this over and over again, is claiming Social Security at the wrong time and in the wrong way, without understanding how that single decision affects every other benefit they're entitled to. It's not just about when you file. It's about how that filing date interacts with your taxes, your Medicare premiums, your spouse's benefits, your COLA increases, and if you're a veteran, your VA payments too. Now, I know that sounds like a lot, but stay with me because once you understand how these pieces fit together, the picture becomes very clear. And trust me, it's a picture you want to see. Let's start with the basics. When most people retire and start drawing Social Security, they assume that check is all theirs, free and clear. And for many people it is. But here's what a lot of folks don't realize. Depending on your income situation, up to 85 cents of every dollar you receive from Social Security can be counted as taxable income by the IRS. That's right. Your Social Security benefit, the money you worked your whole life for, may not be as tax-free as you thought. Here's a real-world example. Let's say your name is Dorothy. Dorothy is 66, just retired, and she's excited. Her Social Security check is about $1,850 a month. She also has a small pension from her years working at the county school system, about $900 a month. Together, that's roughly $2,750 a month, or about $33,000 a year. Dorothy figures she's comfortable. She doesn't think about taxes because nobody told her she needed to. But come April, Dorothy gets a letter from the IRS. And it turns out, because of the way the Social Security income formula works, something called the combined income threshold, up to 50% of her Social Security benefit is now taxable. That's nearly $11,000 added to her taxable income that she wasn't expecting. Suddenly, Dorothy owes money she didn't budget for. She's not in crisis, but she's stressed, she's confused, and she feels like the system failed her. And honestly, in a way it did, because nobody warned her. Now let's talk about the cost of living adjustment, or COLA, because this is where the first-year mistake gets even more complicated. Every year, the Social Security Administration adjusts benefits to keep up with inflation. For 2025, seniors received a 2.5% COLA increase. That means if you were getting $1,800 a month, your check went up by about 45s. Not a huge jump, but it adds up over the year. That's roughly $540 more annually. Here's the part that catches people off guard. When your benefit goes up because of COLA, so does your Medicare Part B premium. And that premium is deducted directly from your Social Security check before it ever hits your bank account. In 2025, the standard Medicare Part B premium is $185 a month. So that $45 COLA increase you were so excited about? After the Medicare deduction adjustment, your net increase may feel much smaller than you expected. This is why financial planners who work with retirees always say, never just look at your gross Social Security benefit. Always look at what actually lands in your account. That's your real number. And if you're on Medicare Advantage or have supplemental coverage, your out-of-pocket situation may be even more layered. The good news is that there is a protection built into the law called the hold harmless provision. This rule says that your Social Security benefit cannot go down from one year to the next solely because of a Medicare premium increase. So if your COLA increase is $30, but your Medicare premium goes up $35, the law protects you from losing that $5. You just don't gain anything that year, but it does mean your benefit is protected, and that's worth knowing. If you are married, widowed, or divorced, Please pay very close attention to this next part, because this is where I see some of the biggest and most painful mistakes happen. Let's say you and your spouse both retire around the same time. You've both been working, and you both have your own Social Security records. A lot of couples just assume they'll each claim their own benefit and call it a day. But depending on the difference in your earnings records, one of you might actually be entitled to a spousal benefit that's higher than your own. And if you don't claim it the right way, you could be leaving real money on the table every single month for the rest of your life. Here's how it works. A spouse is entitled to up to 50% of their partner's full retirement benefit if that amount is higher than their own benefit. So if your husband spent 35 years as an engineer and his full retirement benefit is $2,800 a month, you could potentially receive up to $1,400 a month as a spousal benefit, even if your own work record only qualifies you for $900. That's a difference of $500 a month or $6,000 a year. Over a 20-year retirement, that's $120,000. That's not a small number. And for widows and widowers, the numbers get even more significant. If your spouse has passed away, you may be entitled to 100% of what they were receiving, not 50%, but 100%, as a survivor benefit. The Social Security Administration does not automatically move you to the higher amount. You have to know to ask. And tragically, every year, thousands of seniors, mostly women, collect a smaller benefit for years without realizing they were entitled to so much more. This is another area that surprises a lot of people. Many retirees, especially those who retire at 62 or 63, want to keep working part-time. Maybe you're consulting a few hours a week, helping out a family business, or picking up a seasonal job. And that's wonderful, and staying active is good for the mind and the body. But if you're collecting Social Security before your full retirement age, and you earn above a certain threshold, the SSA will temporarily reduce your benefit. In 2025, that threshold is $22,320 a year. For every $2 you earn above that limit, Social Security withholds $1 from your benefit. Now, and this is important, this money is not gone forever. Once you reach your full retirement age, the SSA recalculates your benefit and gives you credit for those withheld months, so you do get it back, eventually. But in the short term, it can create real cash flow problems if you weren't expecting it. The year you actually reach full retirement age, the rules change. That year, you can earn up to $59,120 with no penalty. And once you cross that birthday, the earning limit disappears entirely. You can make as much as you want without any reduction to your Social Security benefit. Now, for our veterans watching, and I know many of you are out there, I want to take a special moment just for you, because you deserve it. If you receive VA disability compensation, here is something critically important. VA benefits are not counted as income for Social Security purposes. Your VA check does not affect your Social Security benefit, and your Social Security benefit does not reduce your VA compensation. These two programs operate completely independently of each other, and you are fully entitled to receive both at the same time. However, the mistake veterans make is not knowing about the full range of benefits available to them in retirement. Many veterans with service-connected disabilities are eligible for special monthly compensation, aid and attendance allowances, and dependency and indemnity compensation for surviving spouses, benefits that can add hundreds of dollars a month on top of regular VA disability pay. If you're a veteran and you haven't had a benefits review recently, I urge you, please contact your local VA office or a veteran service organization like the DAVI or the American Legion. They will advocate for you at no cost. All right, my friends, we've talked about the mistakes. Now let's talk about the strategies, the smart moves that can help you get every dollar you've earned and then some. First, if you haven't already claimed Social Security and you can afford to wait, consider delaying. Every year you delay past your full retirement age, up to age 70, your benefit grows by 8%. That's a guaranteed inflation-adjusted 8% increase per year. There is no investment in the world that offers that kind of guaranteed return. If you can bridge the gap with savings or a spouse's income, waiting even 1 or 2 extra years can mean hundreds of dollars more every month for the rest of your life. Second, check your Social Security earnings record right now. Go to SSA.gov, create a My Social Security account, and review every year of your earnings history. Mistakes happen. If a year of your income was reported incorrectly, or not at all, your benefit could be lower than it should be. This is a free check and it takes about 15 minutes. I cannot tell you how often seniors discover errors that, once corrected, increase their monthly payment. Third, consider the taxation strategy. If you have a mix of income sources, Social Security, a pension, a 401k, a traditional IRA, the order in which you draw from those accounts in retirement can significantly affect how much of your Social Security is taxable. Working with a fee-only financial advisor or even a trusted tax professional who understands Social Security can help you structure your withdrawals in a way that keeps more money in your pocket. And fourth, don't forget about extra help and low-income subsidy programs. If your income and resources are below certain limits, you may qualify for programs that help cover your Medicare Part D prescription drug costs, saving you hundreds or even thousands of dollars a year. SSI recipients often qualify automatically, but even if you don't receive SSI, you may still be eligible. Call 1-800-MEDICARE or visit ssa.gov to apply. My friends, I want you to hear this directly from me. You have worked too hard and waited too long to let the complexity of this system shortchange you. These are your benefits. You paid for them with every paycheck, every tax filing, every year you showed up and did your part. And you deserve to receive every single dollar you're owed. The number one mistake retirees make in their first year isn't stupidity or carelessness. It's simply not having someone in their corner who explained how all the pieces work together. So please, share this video with someone you love. Your sister, your neighbor, your old coworker who just filed. Because the more we talk about this, the fewer people get left behind. If this video helped you today, do me one favor. Hit that like button, subscribe so you never miss an update, and drop a comment below telling me one thing you learned. I read every single one, and I'll be right here every week, making sure you have the information you need to protect what you've earned. Take care of yourselves, and I'll see you in the next one.